Imagine this. You are the greatest investor in history. You have a track record that is absolutely untouchable. You have compounded returns at over 20% for 6 decades. You are worth over $100 billion, and right now, you are sitting on more than $300 billion in cash. Just sitting there, doing nothing, earning a paltry 4% to 5% in Treasury bills while the stock market continues to hit new all-time highs. It does not make sense, does it? Why would the greatest investor of all time hold so much cash while the market is booming? Why is he not deploying that capital into the stocks he loves? Why is he sitting on the sidelines when everyone else is piling in? The answer is not what you think. It is not that he is scared. It is not that he is too old. It is not that he has lost his touch. Today, we are going to uncover the real reason Warren Buffett keeps billions in cash. The strategy that nobody talks about, the hidden playbook that has made him one of the wealthiest people on earth. And the truth about his cash hoard. It changes everything you think you know about investing. Welcome back to the channel where we cut through the noise and give you the real story on the investments everyone is too afraid to talk about. If you are new here, smash that subscribe button right now because you do not want to miss what is coming. Today, we are going head-to-head with one of the most misunderstood strategies in investing. Cash versus stocks. 2 positions. One is universally ridiculed as a waste of capital. The other is worshipped as the only path to wealth. We are talking about Buffett's actual cash holdings, the historical context, the opportunity cost, the hidden strategy, and the one category where cash is absolutely the most powerful weapon in investing. Let us get into it. The scale of the cash hoard. Let us start where every great financial analysis should start, with the numbers. The actual staggering, mind-bending numbers. As of the latest filings, Berkshire Hathaway is sitting on over $300 billion in cash and cash equivalents. That is not a typo. $300 billion. It is more than the GDP of many countries. And this is not a new development. Buffett has been building this cash mountain for years. In 2019, it was around $100 billion. In 2021, it was $150 billion. Now, it is over $300 billion. The pile is growing faster than ever. Here is the thing that most investors do not understand. Berkshire generates approximately $30 billion to $40 billion in operating cash flow every single year. That is the money from its insurance businesses, its railroads, its utilities, its manufacturing companies. Buffett has a problem, a good problem, but a problem nonetheless. He has more cash coming in than he can responsibly deploy, and he is not going to just throw it at anything. He is not going to buy mediocre companies at expensive prices just because he has cash burning a hole in his pocket. He is waiting, he is patient, he is disciplined, and that discipline is the real reason he keeps billions in cash. The opportunity cost fallacy. Now let us address the elephant in the room, the opportunity cost. The argument that holding cash costs you money. The argument that you are losing out on potential returns. This is the most common criticism of Buffett's cash hoard, and it is completely misguided. Yes, holding cash means you are not earning stock market returns. Yes, holding cash means you are missing out on some of the market's upside. Yes, holding cash has a cost. But here is the thing. The opportunity cost of holding cash is only relevant if the cash is the alternative to a good investment. If there is no good investment available, the opportunity cost is irrelevant. Buffett has said repeatedly that he will only invest in things he understands. He will only invest in companies with durable competitive advantages. He will only invest at prices that make sense. If those companies are not available at reasonable prices, he is not going to force it. He is going to wait. And here is the data that proves he is right. Over the past decade, Buffett has made some massive investments. Apple, Bank of America, Occidental Petroleum. These were not made at the peak. They were made at attractive prices. The cash he held in the years before those investments was not wasted. It was preserved. It was protected. It was ready to be deployed. The insurance company connection. Now let us talk about something that almost nobody understands. The insurance connection. Berkshire Hathaway is primarily an insurance company. It owns Geico. It owns General Ray. It owns National Indemnity. These companies collect premiums and invest the money until claims are paid. The insurance business generates something called float. Float is the money that policyholders pay in premiums but have not yet been claimed. It is essentially an interest-free loan from policyholders to the company. Buffett has used this float to fund his investments for decades. It is one of his secret weapons. But here is the thing about insurance. The claims are unpredictable. Hurricanes happen, earthquakes happen, fires happen, pandemics happen. Buffett needs to keep enough cash and liquid assets on hand to pay claims. He cannot take the float and put it all in stocks. He needs to manage the risk. This is the hidden reason that Berkshire holds so much cash. It is not just for investment opportunities, it is also for operational safety. It is to ensure that the insurance companies can pay claims no matter what happens. The data that changes everything. Now, let us get to the part that will fundamentally change how you think about Buffett's cash strategy. The data. The hard, objective numbers that tell the real story. Do you know what percentage of Berkshire's total assets are held in cash and equivalents? It is approximately 25%. 1/4 of the entire company is in cash. Now, do you know what percentage of the average investor's portfolio is in cash? It is less than 5%. Most investors are virtually fully invested at all times. Here is the most important data point of all. Over the past 60 years, Buffett has made his largest investments during bear markets. During the 1973-1974 crash, during the 1987 crash, during the dot-com crash, during the 2008 financial crisis, during the 2020 COVID crash. Every single time he had cash, every single time he bought at the bottom, every single time he generated returns that made the earlier opportunity cost look irrelevant. The data does not point to a cash problem, it points to a patience problem. The investors who are always fully invested are forced to sell at the worst possible times. The investors who hold cash can buy at the best possible times. And that is the truth that the financial content world does not want to say out loud, because it is easier to tell you to buy and hold than to tell you to be patient. It is easier to tell you to be fully invested than to tell you to wait for the right opportunity. The final verdict. So, after everything, the scale of the cash hoard, the myth of idle cash, the real strategy, the opportunity cost fallacy, and the insurance connection. What is the verdict? Here is the honest answer. It depends entirely on your perspective. If you are a short-term investor, if you are trying to maximize your returns every single year, if you are obsessed with beating the market every quarter, holding cash looks like a mistake. You see the missed opportunities, you see the underperformance, you see the waste. If you are a long-term investor, if you are patient, if you understand that market corrections are inevitable, holding cash looks like genius. You see the dry powder, you see the optionality, you see the strategic advantage. Now I have a question for you. Do you hold cash in your portfolio, or are you fully invested all the time? What is your strategy? I want to hear your thoughts. Drop a comment below and let me know. I read every single one. And if you know someone who is always fully invested and worried about market corrections, share this video with them. It might change their entire perspective on investing. If this video gave you a new way to think about cash, do me a favor and hit that like button. Subscribe to the channel and turn on the notification bell. We drop new videos every single week that challenge conventional financial wisdom. Next week, we are diving into something even more controversial. You will not want to miss it. Until then, stay patient, stay disciplined, and always keep some dry powder ready.